Welcome to the Mr. R Show, presented by the MRR Institute. This podcast is designed specifically for tax professionals looking to scale and modernize their practice by maximizing revenue through resources. Join us as we explore expert strategies, innovative tools, and actionable advice to help you navigate the evolving landscape of the tax industry. Whether you're aiming to grow your business or enhance your client experience, you're in the right place. Now, let's get to the show and transform your practice together.
Hey everybody, welcome back to the Mr. R Show. Obviously, we know you're here because you are in the industry or looking to get into the tax professional industry, and we welcome you. For lack of better terms, you're in a great place. You're getting in at a great time if you're not in it yet. Obviously, if you're in this industry, have been for a while, have been for a short period, you obviously know what things are all about. So here we are. We're not going to tell you everything about the job that you have, the very important position that you hold in many people's made businesses' lives, but we are here to talk about some tips, tricks, advice, topics, you name it, how we can help you enhance your life. So before we get into this, though, I do want to mention, do not forget about your free CPEs. So look in the show notes of this, wherever you're listening to it in, regardless what platform. And what you're going to want to do is you're going to get off of this. But before you do that, click on the link that is directly in the show notes. And that is going to take you over to our friends over at EarMark, who is gladly going to give you that free CP after listening to it from there. So what I mean by that is you cannot listen to it here, go back into EarMark later. You need to stop what you're doing, click on that link, and re-listen to this through EarMark's app. So without further ado, obviously we're here. We're going to talk about reframing, risky little form 1040, some people might say. So what exactly does that mean? What exactly are you going to take away from this? We are going to dive into that brain that's full of information of Chris Picciurro. So Chris, welcome back, man. I'm glad to do this show with you because obviously you know a whole lot more about this than I do.
Excited to be back. And first of all, listeners, thank you so much for your support. As tax and accounting professionals, we know we have challenges. We know that this industry is not shifting. It has shifted over from compliance to more advisory. And in my private CPA practice, which I'm a firm owner, like many of you listening here, and many people listening that aspire to be a firm owner, or one day. And we are going to talk today about reframing Form 1040 and looking at that instead of just thinking about it as a compliance task, going from compliance to opportunity. And, as a tax planner, so my role now in our private CPA firm and in the teaching tax flow community is doing tax planning and strategy. So when I look at a tax return, I'm not looking at it necessarily from a compliance perspective. I'm looking at it, okay, what did that taxpayer do to legally and ethically reduce the tax they paid? What can they do moving forward? So I'm excited to just kind of just to share how I look at things. Hopefully something resonates from this podcast episode to you, and you feel so inclined to jump into our private Facebook group, Tax Pro 2.0, and would love to hear from you. Would love to collaborate. That's a free group for any tax and accounting professional. We have a lot of great interaction in there, and we collaborate quite a bit. So what we're going to do today is we're going to look at 3 core forms, all right, or 3 core schedules. Schedule A, C, D, and E. We're going to walk through each schedule one by one and talk through opportunities that exist in each schedule. And then after that, we're going to talk about how to unlock those opportunities through advisory. Because it's one thing, we always talk about in our private CPA practice, ideas are cheap, implementation is valuable. So how can you take that opportunity? And many times you see that opportunity for your clients. However, you're not exactly sure how to execute that, how to implement that and unlock that value through advisory services.
So pretty much, Chris, what we're going to talk about here, right, is like just getting out of that very straight line role of tax prep and expanding the offerings that are right in front of people, right? Is that what I'm taking from this?
Absolutely, because a tax return's a snapshot. It's a snapshot of what happened the year before. And we know that your tax returns should be a verb and not a noun. So let's talk about, but before we dive into those core schedules, let's talk about compliance versus planning. All right. Going from compliance to opportunity. And gosh, you and I, we talk to tax professionals and accounting professionals all the time. And one of the themes is, man, all these tax returns are bogging me down. Um, and I see opportunity to do tax planning and strategy. I just don't know how. I don't have it. I don't know how to price it. I don't even, I don't know how to frame it. And let's talk about that. So, what is tax planning, first of all? Tax planning is something proactive. I look at tax planning as everything moving forward. It's proactive strategic management of your finances to optimize or reduce your tax over the year, where tax preparation is very reactive, right? It's compliance focused. And it's just, like I said, it's a scorecard of all of your financial activity from the year before. So think about that. Tax planning and strategy is everything looking forward. Tax compliance is everything going backward.
And I feel too, Chris, I mean, from a more of a taxpayer's perspective, right? So if anybody's listening to this, obviously this might be how your clients better see this. Is I think the stereotypical, we're not going to get into the pocket protector stereotype of the accountant back in the day, but I think we'll call it, the modern tax pro, right? Like we refer to that, in some regard in many places, that there's a lot more obviously opportunity for growth for firm owners, for CPAs, any tax pro now, well beyond what I think was the expectation years ago, right? Like you're definitely more of a advisory role, more of a, a confidant, if we will. You're more ingrained in this, and you're not just the person that they email once, drop off papers once a year, sit down with for 15 minutes, and a return's done. It's a much more in-depth relationship that, as we're going to talk about, is much more year-round, correct?
Absolutely. I mean, your clients want you to be around year-round. They want you to be available, and that's where the value is. Let's talk about value, right? The average tax preparation fee per client is about $400. So annually, the average tax planning revenue per client is about $3,200 annually. So that's an 8x. Okay. Now, again, a lot of times you have to do some of the tax preparation work to get involved with the tax planning. But think about that average revenue per client of 8 times your tax planning versus tax preparation. Right. So let's talk about our schedules. So we already know that the tax planning, tax strategy does create more revenue for your firm, but quite frankly, it also provides more value to your clients. And we're going to talk about how to frame that, like I said, reframing in this 1040. But let's look at a Schedule A, right? What do these schedules reveal to us? So Schedule A reveals itemized deductions. It's really it can open the door to strategic giving, property tax timing, and healthcare expense planning. So ultimately, with the way I look at Schedule A, it's an opportunity for us to take personal expenses and make them tax deductible. That's what we're trying to do. Schedule C, we dive into sole proprietorships, as you know, single member LLCs, disregarded entities, and Schedule C also tells us about should someone be a single member LLC or sole proprietor. So how should they structure their entity? Are they taking advantage of all their business deductions, and are they contributing to retirement? Schedule D, we know that's capital gain and losses. A lot of times there's opportunity to pay a lower tax on long-term capital gains. There's also opportunities to harvest losses and do investment planning. And remember, if you're a tax professional, financial advisors are going to be people you work with a lot. So when you're working on Schedule D, you're in contact with the financial advisor. Some tax professionals are involved with financial advising as well. And one of the hidden tax benefits are understanding the difference between realized and unrealized capital gains and losses, right? An unrealized capital gain and loss. John, you could have bought Apple stock for $100. Now it's worth $100 worth of Apple stock. Now it's worth $10,000. If you don't sell it, you don't pay tax on it. So you have an unrealized gain. So you're not taxed on that until you actually sell it. Conversely, if you bought it for $50,000 and it went down to $40,000, to take that capital loss deduction, you have to sell that stock, and then it comes down to, when can we deduct these capital losses? But so Schedule D is a window to someone's assets and brokerage assets and that sort of stuff. I mean, it also can help you. Let's say you have a client that's self-employed and you realize they have a decent amount in their brokerage account and they're eligible to make retirement plan contributions. Just by taking that money from their brokerage account and putting it into maybe a SEP IRA, they now get a tax deduction. There's no necessarily money out of their pocket. We call that a behavioral tax planning implementation. So just like, Johnny, I know you hear me talk all the time about how tax planning implementations don't like to be single. They like to mingle. They like to jingle. They like to be stacked. They like to be blended. These schedules don't just live in a silo. A lot of times there's an interaction between them, especially when we're talking about Schedule A. So a lot of Schedule A deductions are based on your adjusted gross income. Well, Schedule C and Schedule D can really affect your adjusted gross income, right? So, so you could.
I think if anybody takes anything from this show, maybe they should just try to remember that, right? That if Chris Picciurro ever retires, which is never going to happen fully, I can probably say that confidently. Maybe you'll create that quote unquote strategy dating app, which you're always joking around about, right? Because you're right, they definitely do not like to ride solo. They need somebody riding shotgun with them, or a party of many.
Well, think about it. Let's say your itemized deductions. Let's say you have some medical expenses, and we know there's a 7.5% adjusted gross income threshold, and we're going to dive into this a little in a couple minutes. And you have Schedule C income. Well, if you put money in a retirement account, it reduces your adjusted gross income. So not only are you reducing your taxable income, but you're also increasing the amount of medical deduction. Let's say you have a big capital gain on Schedule D, but you have some stocks and mutual funds and stuff that lost money. You want to harvest those losses. So there's a lot of interaction between these schedules. They don't just sit in a room by themselves. Then that fourth schedule that we're going to talk about, our core schedules, is Schedule E. So Schedule E is going to tell us about your a taxpayer's rental income and deductions, and also income deductions, et cetera, from pass-through activities. That's going to be your trusts, your estates, your S corps, your partnership returns. There's a lot of things that Schedule E can uncover. It's also going to tell us if someone's maybe a real estate professional status, or if they have passive activity losses. And those we know are stuck on Form 8582. So these core schedules, A, C, D, E, are really, I look at that as the basis of tax planning, right? Because yes, W-2s and other income is out there, but you really can't control what's on your W-2 unless you tell someone to earn less money, which would be silly. But we can legally and ethically stage these schedules.
And for somebody that maybe, listen to this show that's thinking about getting into the industry, you may have noticed something's maybe missing or maybe off from what Chris was just saying, right? And whatever actually happened to Schedule B? Was that ever a thing? With those, skips B as in boy.
Yeah, Schedule B, there's a Schedule B. Schedule B reports your interest income and qualified dividends and your dividends. So it is important. I would say if you're working with a client that has a large amount of income on Schedule B, that's going to be an indicator that they have a significant amount of assets in the bank, maybe in CDs and just gaining bank interest. So that means they probably have a lot of liquidity. But the thing is if you took it out of the bank and didn't earn interest on it, you don't have as many planning opportunities as A, C, D, and E. It's just a good indicator of someone's financial liquidity and balance.
That makes total sense.
Yes, there are a lot of schedules. I just didn't feel like B was a core schedule.
No, it makes total. Otherwise, this would be a 6-hour show, right? We can go into all kinds of stuff. So makes sense.
Well, let's look at Schedule A. We know Schedule A are itemized deductions, and we're going to look at this as our first of the 4 core schedules. And we're going to talk about opportunities that are available on Schedule A. So we know that medical and dental expenses are deductible, but the only deductible amount is that are the expenses that exceed 7.5% of uh, of someone's adjusted gross income. Now, there are special rules if you're self-employed and you have health insurance premiums that you could deduct your health insurance premiums up to your self-employment income, or if you're an employee somewhere, I'm hoping that you're you're getting your health insurance premiums are going in what are called pre-tax through your W-2. But what could we do on itemized deductions as far as medical and dental? Well, first thing would be is bunching your deductions across years. So let's say you have a medical expense. Well, I mean, quite frankly, let's say you've got 3 kids like I do, and they all need dental. They all have a lot of dental expenses. And assuming no one's in pain or anything, it might make sense to say, all right, I've got 2 kids that need braces. If I pay for one this year and one next year, I'm really not going to go over that 7.5% threshold. So let's slap the metal on the kids' mouths, both on the same year. So bunching deductions across years is an opportunity for medical and dental expenses. Using health savings accounts is a really great opportunity. Now, health savings account means putting money into that HSA pre-tax. It's almost like an IRA for health expenses. So if you have a client that has a lot of medical expenses, but they're not able to use them because either they're not itemizing or they don't exceed the 7.5%, make sure that they are at least contributing to their HSA if they are eligible. I can't tell you how many times I've mentioned, "Hey, are you eligible for an HSA? Oh yeah, I am. Well, why don't you fund that? So at least that's coming off your adjusted gross income and you're not paying tax on that money, on that income, instead of paying all your medical expenses with after-tax dollars." Um,
And that's just one example, right? I mean, in full transparency, I was very shocked, pleasantly surprised when we started diving into that a while back, right? It was like, it almost took a moment, from, again, the taxpayer's eyes. You're like, wow, okay, I didn't know that. And that makes, wow, a lot of sense. Like, it's shocking, right? So when we're talking about these advisory roles and you really, knowing your clients more than just a transactional relationship once or twice a year tops, like these are the things, right? This one specifically, you get to know them better. Like you gave the example of braces, right? Like what are the chances you would know a client may have some dependents that are in need of braces if you only meet with them for 30 minutes a year? It's not going to happen. But when you start adding this advice to them, I mean, talk about the immense
yeah.
amount of value that
So
this provides to a
if you're
family.
looking at a
Huge.
tax return and they have a lot of medical and dental expenses on Schedule A, but are not able to deduct a majority of them or any of them, that's a trigger to say we've got opportunity. Um, a lot of times people have long-term care premiums that they're not deducting because they just don't know. They didn't realize that they could deduct them. So, long-term care we had is an issue in a planning opportunity in and of itself, but those long-term care premiums are deductible. Here's another one, John: mileage and travel for medical purposes, right? Especially if, let's say, you live in a more rural area and you have to drive a long way to go to your doctor or dentist, or let's say you have physical therapy and you're driving, 20 miles each way to your physical therapist. Let's say you go 3 times a week. That mileage can add up. You can get a standard mileage deduction for medical travel, right? So
That is an interesting one that, you kind of compare that to, it's always a known fact, right? Business owners usually, in most cases, I imagine, take care of, mileage deductions. But who would have ever thought, right? Your average taxpayer would probably never think of this, right?
exactly, they wouldn't. And then claiming medical costs for dependents and relatives. If you are claiming someone as a dependent, like a child or something like that, the medical expenses for that person are deductible on your return. And sometimes we just forget about it. And sometimes you might have a dependent that's in college, they're away, they have to go to seek medical care, and you kind of forget about it. So those are deductible as well. So that
And and honestly, Chris, as we keep going along in this too, I do want to, and I'll probably bring this up a couple times, but I think this is really important to this audience, right? So obviously, me and you, we also do the Teaching Tax Flow podcast, right? And that is very, very, I should say, very. It is. It's directed more towards the taxpayer, and obviously, this one is
right.
the other side of the fence. So I feel like we have some of the same
Mhm.
conversations. However, I really do like doing these because it's almost like we're having roundtable discussions with people that are also providing the services. We're kind of helping out both sides by doing this. So I look at this again more from the
Right.
taxpayer's eyes, and again, we're only at the beginning of this. There's a lot more we're going to dive into. 30 minutes plus of this stuff. Think about it too, right? Like if you go in, I'm just literally trying to think of an example off the cusp. Like say you are, let's use an auto mechanic for an example. I don't know if this is going to make any sense because I'm literally thinking of this as we're going through it, right? You're buying the car, you're using it, get wherever you're using it to commute. You as the owner of that vehicle, say you're not a gearhead, say you're not really into cars, you just use them to use them, they're a
Mhm.
utility. Don't It would be very important, and you would always try to find an auto mechanic that knows about your vehicle, right? That knows the model, the make, they have the most current software because we all know that pretty much all of our cars now, you need a computer to work on these things and to operate them. Which is why I think it is super important, and there's so much value in that when a tax professional really kind of takes that the ownership of the relationship, not, ownership in a bad way, but like, "Hey, this is also what we can do. This is what I can offer you," instead of waiting for the client to ask you for it, right? Because that's if you go to an auto mechanic that's like, "Yeah, I just work on cars. I work on them all. I don't know. I figure it out as I go through it." That's like going to a tax professional that, doesn't follow up with tax law updates and changes. And, that's why that advisory role, I think, is so important. And most taxpayers probably don't even realize it
Mhm.
exists unless you tell
Mhm.
them, right? So I'm sorry to kind of get on a soapbox a little bit there, but I really think it's a thing. It's an issue, maybe.
Well, and so we're gonna work. Yeah, you wanna be more than just a compliance based person with your clients. So Schedule A, we're gonna work into the itemized deductions. We already talked about medical. Let's talk about taxes. Right. So big change very recently with the one big beautiful bill act. Remember that SALT, state and local income tax deduction, was only $10,000 a year, which now in 20 we just had a big change that's $40,000 per year, right? There's still a lot of opportunity. There's still a lot of people that, believe it or not, pay more than $40,000 of state and local income tax. And because that not only includes that includes property taxes. In many states, property taxes are very high. So if you're looking at a tax return and someone is paying much more than their deductible limit, now $40,000 up from 10, a huge jump. But let's say they paid $80,000 of state tax. What can you do? What advice can you give them other than tell them to move to a state with no income tax? Well, you might want to prepay some of your property taxes or income taxes. Remember, you're a cash basis taxpayer, similar to the medical. You're bunching them. So if you have a fourth quarter estimated tax due, and you're in a year that you aren't at that SALT limit yet, you might want to pay that before December 31st, even though that fourth quarter tax is not due till January 15th of the next year, or property taxes. And then you might want to talk to your clients about the PTET. So that's that pass-through entity tax, depending on what state you're in. So those are things you're going to want to look at to determine if your client could benefit from either of those two opportunities. Let's talk about charitable deductions. All right. That's going to be the last big thing on our Schedule A that we're going to discuss. Now, itemized as far as medical expenses, taxes, and charity. There are other deductions on Schedule A, but these are the big ones, right? What can we do for charitable deductions? We know that charitable deductions are only, or charitable contributions are only deductible if you itemize. So many, many people make charitable contributions and don't get a deduction for it. So if you run into a situation where you're working with a client and looking at a tax return where they're making charitable contributions and not getting a full deduction for it, or if they're making if their charitable contributions exceed the deduction amount it carries forward, what should you consider doing? Similar to taxes and medical expenses, consider bunching contributions into a single year. So if one year someone's not going to itemize their deductions and the next year they're probably going to, then maybe you just wait a few weeks and make that contribution into the next year, or accelerate a contribution into a previous year. So in other words, bunching the charitable contributions into a single year. That's a great opportunity. You talk to your clients about DAFs. That's called donor advised funds. So typically, if someone's donating $50,000 more or more of cash per year, they might want to consider donor advised funds. Have your client talk to their financial advisor about that. That allows them to take the immediate deduction for the money put into the DAF without necessarily having to deploy that to a certain charity. Because here's the thing, a lot of times someone wants to be charitable, but they're not 100% sure what charities they want to contribute to, but it allows them to take that deduction. QCDs, great opportunity, qualified charitable distributions. I can't tell you how many times we have taxpayers that are taking their RMDs, required minimum distributions, only to turn around and donate those to charity. So you've got a mature age taxpayer taking money out of their retirement account, paying tax on that, driving up the taxability of their Social Security, only to contribute to a charity and not get a deduction. Well, why don't you think about a QCD where they could have the money go directly from their retirement account to the charity and avoid tax, and the charity still gets that money for their operations.
That was one of the topics we talked about a while back on the Teaching Tax Flow podcast, and it's wild. It's another one of those. I think it's a lesser known, right? Like who would have thought? I mean, that was a great topic. When I think we had a guest for that one that went into it, and yeah, it's awesome. Like once you know about those, and for the taxpayers, it's unfortunate, but obviously it's never going to happen. It'd be nice if there was billboards up and down the main freeways that told us these things, but fortunately for everybody in the industry, that's where the opportunity lies,
Right.
to extend that value.
Oh, absolutely. There's opportunity there. And it like I said, it satisfies that required minimum distribution. Think about donating appreciated securities instead of cash. Give you an example. Remember that Apple stock, John? Let's say you wanted to be charitable. You bought Apple stock for $1,000. It's worth $50,000. Well, if you sold the Apple stock for $50,000 and then donated the $50,000, you'd have to pay tax on $49,000 of capital gains. But if you just take that Apple stock and transfer it in kind to the charity, you get a deduction for $50,000 without having to pay that capital gains. So that's donating appreciation.
The only thing that makes me feel better about this, and you keep referring to Apple because I'm like a giant fan of Apple products, is that I probably have spent $50,000 for the past decade in Apple products. That's my only win. I don't own any Apple stock, unfortunately.
Well, it's an easy one to think about because we know it went up. We know it went up.
I know what you mean. No, it is a good example. It's a very good example.
And then leverage charitable giving, which is a really advanced tax mitigation strategy, and then maybe establishing a private foundation. So when you start getting into the situation where you have $500,000 or more of income, that's where leverage charitable giving and a private foundation, it might make sense. Since that's not the majority of taxpayers, if that rings a bell to you or speaks to you, just reach out to us here at the MRR Institute, and we will guide you in the right direction. So that is Schedule A, and we're moving on to Schedule C, business income, right? So Schedule C, that's where self-employed people report their income, or someone that has a single member LLC as a tax professional. If you had $1 every time someone thought forming an LLC was going to give them more deductions, we'd all be retired, right? But we know that that's not the case. So,
oh yeah, that was one of the first podcasts me and you did. It was I forgot what the actual title was, but yeah, it was a hot topic in that one. And if anybody here, you've had the pleasure of meeting Chris, or you will hear soon in person, just poke the bear a little bit and ask him about how many times he's been asked that. So
Oh yeah,
it's fun. I have fun with that.
it's amazing. So when you're looking, let's talk about Schedule C, and let's look at the business income and deductions, right? So let's say you have a client that has a large amount of Schedule C income. Now we know Schedule C income is the highest taxed income. Why? One, you're going to pay your federal tax on that. You're going to pay state and local tax on the net income. You're also going to pay self-employment tax, 15.3% on that income up to the Social Security maximum, and potentially the Medicare surtax. So it's the most highly taxed income. That's the way you have to think about it. So every dollar of tax savings you can find for your client is very, very valuable. So what do you do when you run into a client that has a significant amount of Schedule C income? All right. One, consider doing some income shifting to a related entity or family member. Obviously it has to be done legally and ethically. People have to we know that there's some abuse as far as abusive schemes as far as, shifting income. But think about, is there a related entity or is there a family member that they can shift that income to and move it out of a high marginal tax rate to a lower marginal tax rate? Two, if you're employing your spouse, remember this might consider implementing a Section 105 medical reimbursement plan. So let me speak on that for a second. Let's say that you're a solopreneur. John, you like that let's say you're a mechanic, right? And you've got a garage behind the house, a pole barn, and you work on cars, you're a one-man band, you're a Schedule C. But your spouse helps you out with the billing, the bookkeeping, and that sort of stuff. And you don't have any other employees. Well, and you have a high amount of net income. First of all, good for you. Well, maybe you want to hire your spouse and then and pay them a reasonable wage, but then also do a Section 105 plan and take all of those medical expenses. Remember, I said these schedules dance around together. They're on Schedule A, and have the business reimburse the spouse for those medical expenses under what's called a Section 105 plan. So now, not only are you deducting all those out-of-pocket medical expenses, you are also getting a business deduction instead of a personal deduction, which is better. Schedule C deduction is more powerful than a Schedule A deduction.
Which is a beautiful thing. And again, as I said it before, and I'll say it again and again and again, the average taxpayer probably has no idea that even exists. Right.
Right. So what we're looking for as a tax professional, we're looking for opportunity. You see the tax return in a different light than your clients. So when you're seeing this, these are some of the things that you want to look for. The other one is home office deduction. Look at that Schedule C. Are they eligible for a home office deduction? Did the taxpayer take the home office deduction if they're eligible? Obviously, we've got that actual expense method or simplified method. You're going to use it Form 8829 for that actual expense method. Other thing you got to look for, are they making retirement plan contributions? Another one, should they be an S Corp? Now, like many other tax professionals, we know that S corporations are probably the most overused entity. They're misdiagnosed, but at times they could be very powerful. So should your client be an S Corp? Think about that. If you're using an S Corp, should they have an accountable plan? So with an S Corporation, if your client has mileage, if your client has home office, you could create an accountable plan and have the S Corporation tax-free reimburse the employee, which is also the owner, for many business deductions and be very tax efficient. Make sure you're taking advantage of that Section 199A QBI deduction. Always track your business miles and vehicle expenses, and think about blending all of these strategies. How many times do you look at Schedule C and many times you don't see a deduction in car and truck expense line? Unless a person never drives, which could be the case. So let's say you're a coder and you just work in your basement. You haven't, that could be the case. But most people have some type of business mile. So what I'm looking for in a Schedule C is, do they take home office if they're eligible? Are they making retirement plan contributions? Are they, you know, do they have the car and truck expenses? Should they be an S corp? Those are all considerations on Schedule C. Now we're going to mosey over to Schedule D. We know that Schedule D reports our capital gains and capital losses. What should you be looking for your client? Well, first thing you're going to do is look at the client's Schedule D and say, do they have any capital loss carryforwards? If they have capital loss carryforwards, then they have opportunities to harvest capital gains and pay no tax on it. That's pretty cool. Now remember, capital gains and losses report all of your sales of stock, mutual funds, bonds. It also could report your sale of business interests. It could report a sale of a bunch of different rental properties. It'll all eventually flow onto Schedule D. So, opportunities. Harvest capital losses to offset capital gains. So if you have a client that seemingly has a lot of capital gains every year and they have capital losses sitting that are unrealized, harvest those losses. Harvest means sell those assets and take that capital loss. Remember, you can offset up to $3,000 worth of ordinary income with capital losses. So even if they don't have any capital gains, you might as well harvest the $3,000 a year and offset those W-2 wages and other income. Let's say you harvest those capital losses and you actually have $4,000 of capital losses. We know as a tax pro that we're going to be able to carry forward any unused losses. And that's not terrible. I mean, there's plenty of times where you might have a client that you're working with that says, you know what? I've got some stock I'm going to be selling. I'm thinking about selling my business, in 2026. Let's say we're halfway through 2025. But I bought some stocks that were duds. Hey, let's just harvest the losses. Yeah, we could take $23,000 in 25, but I already know you're going to have capital gains in the future. Let's walk into 2026 with some losses that we're going to be able to utilize. So timing those capital gains and losses strategically is important. Other thing, think about qualified opportunity zone funds. With the OBBA, there's been an expansion of qualified opportunity zone funds available. They were super popular in 2017, 2018, 2019, and they're going to be coming back. So remember, qualified opportunity zone funds can offset any type of capital gain. Doesn't have to be real estate. So that's huge. If you have an asset that you're going to sell, so you probably, if you're listening to this, you might have a client that owns a business. Maybe they own land or something, and they say, you know what, I'm going to sell this. I don't really need the money right now. Now, again, you could do a 1031 exchange, but what oftentimes happens is you've got a multi-generational business, right? You've got the matriarch, the parents maybe run the business. A child or two is starting to take over, and they want to sell them the stock. They don't need the money right there. Maybe you should do an installment sale for capital gains, right? So if you have large gains, maybe an installment sale might make sense. Heck, it might even be your accounting practice. Maybe you're listening to this and you want to sell your accounting practice. Doing an installment sale, as you know, is going to spread those gains out. Now, if you have a gain of over $500,000, or you're working with a client that has a pending gain, you might want to consider something called the deferred sales trust. This is a pretty complicated or advanced tax planning strategy, but it allows clients to basically create an installment sale when one doesn't exist. So, John, let's say you owned business stock, and you're going to sell it for $5 million. You don't necessarily need the money today, but the buyer's paying cash or getting financing for it. You want to have installment sale treatment for tax purposes, but it's really a cash sale. That's where deferred sales trust comes into play. So that is an option. That is an option there. And then, think about Roth conversions. So if you're in a down market, right? If the stock market's down, it's not going to show up on Schedule D. When we talk about capital loss harvesting, Remember, if you convert, so think about that stock. Let's say you bought stock for $10,000 and it went down to $2,000. You still believe that stock's going to be valuable, but it's in your IRA. Maybe you convert that to a Roth and just pay tax on that $2,000. Try to avoid the NIT, that pesky net investment income tax, and try to stay below the capital gains thresholds, meaning we know that capital gains, the tax on long-term capital gains are based on your other income. So again, this is where Schedule D plays a role with other schedules. So our final core schedule we're going to talk about, it's probably one of my favorites, Schedule E. Why? Because I love real estate. Our private CPA firm niche is real, like I said, real estate. And we know that rental properties and pass-through income are reported on Schedule E. So when you're looking at Schedule E, a lot of times it tells you a lot about your client's tax situation, right? It tells you, do they have passive income? Do they have passive losses? Do they have non-passive losses? Do they have passive activity loss carry-forwards? What's going on with these properties? What type of properties are they? Are they short-term rentals? Are they long-term rentals? Are they apartment buildings? Are they land? Are they getting royalties? Are they getting K-1s from an S-Corp, a partnership? There's a ton on Schedule E, in Schedule E, page 2, that gives you a window into what, how you can help them. So let's first talk about part 1 of Schedule E. That's going to be your rental real estate, right? What are some opportunities for your clients to legally and ethically reduce the tax they pay in their lifetime? That's what we do in our practice and help people. 1, are they rep status? Do either one of the spouses qualify as a real estate professional status, which would make those rental activities potentially non-passive? Should you group rental activities together for material participation purposes? That's especially important when you're a real estate professional status. Do your rentals, assuming you have net rental income, qualify for the 199A deduction? There's actually a safe harbor available to get the QBI deduction on rental income. It is available. And some people use it. Should you use a cost segregation study, right? Are you looking at a client's tax return? They either have the short-term rental loophole, they're either a rep status, or maybe they just have passive income that they're not using, and you could do a cost segregation study. Now that we have bonus depreciation back up to 100% with OBBA, I think this is going to become more prominent. I already mentioned, I let the cat out of the bag, that short-term rental loophole, right? So are they operating a short-term rental property and have material participation that could qualify that activity as non-passive, and you pair that with a cost segregation study? Do they have passive activity losses? Like I said, maybe you have someone that has so much in passive activity losses, they can absorb some passive activity gain. Or they might be able to sell a property that's a passive activity and pay no tax on it because they have other losses. So there's a lot of opportunity there.
And you said that magic word of pairing, right? That keyword of pairing things together. Right? You mentioned actually a couple times just in this alone, and even in real estate, right? Like the opportunity I think is huge, right? Especially in real estate in that world, because you're bringing in a lot of sources of opportunity, right? So having a solid understanding of the Schedule E is it's a key to a very vast world
Absolutely.
of ops, right?
I talked about this already. Do you have a client? I work with a lot of people that have rental properties that say, you know what, I'm going to sell the rental property to the tenant, but I'm going to sell it to them on an installment sale because this person is a good tenant. They want to have home ownership. They might not qualify for a mortgage at the moment, but we want to keep them in that property. So we do an installment sale. What happens if you have a client that sells a property that doesn't need the cash? I'm just looking at these all the times. You might have an opportunity to do a 1031 exchange. You might want to group your rentals for aggregation rule purposes. You might want to make the de minimis safe harbor election that allows you to take a deduction for any expenses that are under $2,500, even if it's something you would normally capitalize, like think about a refrigerator or a major repair. And then sometimes you actually want to elect out of bonus depreciation, right? So let's say you put an asset in a service with a rental property, and let's say you're getting 100% bonus depreciation and you really don't need that deduction this year, then elect out of it. So the bottom line is sometimes you want to bring more income into Schedule E rental. Sometimes you want to get some income out of there. It's just about managing that and looking for those opportunities on part 1 of Schedule E, which are your rental properties. Let's talk about part 2 of Schedule E, pass-through entity income. Obviously, you're going to need the tax returns for these entities to do the really advanced planning and to truly start implementing some advisory services. Most of the time, if you're working with a client, you're preparing the tax returns for their entities, right? So let's think about that. If you have a client that's an S Corp owner, make sure they're paying themselves reasonable compensation. A lot of times people are paying more than reasonable compensation. We know that 0 is not reasonable compensation. I had a client that I was working with on a personalized tax plan that was the reasonable compensation for what they're doing was about $70,000 a year. It was we did a reasonable compensation study. They're paying themselves $250,000 on a W-2. So they're paying way too much in payroll taxes than they needed to. So think about that. So look at that K1 from S Corp is going to tell you some information. You're also going to have that W-2. At times, the entity, we talked about retirement plan contributions as a Schedule A tool or in the Schedule C, but let's say the entity is an S Corp. Well, the S Corp might implement a simple IRA or 401 solo K plan. So maximizing retirement contributions to the entity that reduces the taxable income on the K1 as it hits Schedule E. Should you look at if you see multi-member LLCs, does it make sense to be that S Corp? Again, I cringe at even saying it. John, you know how much I think S Corps are overused, but when you're looking at that K1 income, is the entity selection proper? Are fringe benefits being optimized at the entity level, right? So that's another thing. Again, are there expenses that are kind of personal in nature that we can make a business expense through either an accountable plan or a Section 105 plan, Section 125 plan? So is there an opportunity to put some fringe benefits on the getting paid by the entity and reduce the K1? And is there income shifting available in family partnerships, right? Because if someone's a multi-member LLC, some of the same principles that I talked about on Schedule C are the same. So look at those K1s and see if there's a legal and ethical way to reduce those. Now, I'm going to wrap up because I think we went through Schedule A, Schedule C, Schedule D, Schedule E. I'm going to wrap up and say, how do you unlock the year-end value with advisory services? And we really dove into this quite a bit, John. I know that you're part of our mastermind group, our peer-to-peer mastermind group here at the MRR Institute. And everyone in the mastermind group, and there's probably 15 or 20 people in each mastermind group, provides advisory services. They all do provide advisory services. The difference is who's monetizing it properly. Have you met, you've met a lot of accounting professionals. I don't know that any of them that are not, what's your perspective on on this topic as far as is it getting monetized? And do you feel like accountants are providing advisory services if they know it or not? Oh, John, you're muted. I'm sorry, my man. I threw you so off guard by this question. You didn't know what to do.
Oh, yeah. You definitely caught me off a little bit there. But hey, you know what? Technology is what it is. Mute buttons exist for a reason. Can you be coughing in the background? But, to answer your question there, Chris, yes, I have a very unique perspective on this, right? Like, obviously, I think I know more about taxes than the average person through osmosis with you and others. But you're right. Like, to get into that, I think it is very interesting to be at those conversations, at the table when they're taking place. It's almost like a lot of tax pros, they say that, oh man, I'm just frustrated with clients, the situation, I'm overworked, and this and that. And then almost in the same conversation, I don't know if a lot of them realize it, they do get into kind of oh man, but yeah, then they're asking for all this stuff and I'm giving it to them. But then, as we're listening, I think we all hear like, hey, but you're doing that for free, like for zip. It's not everything's pro bono. So I would probably say if I had to put a number on it, I would, uh, and I could be wrong. Again, my viewpoint's a little different. I'd probably say that 3/4 of people are giving it away for free. And I would also probably say that 9 out of 10 of those actually already realize that they're providing those services for free. They just don't know really the best way to handle monetizing that in some way or another. And not being greedy about it, right? They just don't know, how to take a next step. And again, I could be wrong. I don't know if I'm right or not.
No, I agree with you, and so that's why I want to finish this episode talking about how you're going to unlock the year-round value with advisory services. There are two different buckets of revenue that can come in. Your first bucket's going to be what I call your top line revenue. That's going to come into your practice. Now, sometimes people create a separate entity for this and a consulting side, but there's that, and then there's a second bucket of revenue that can come in from strategic implementation partners. So let's talk about that first line. The top line revenue or the top line revenue could be brought in 3 different ways. Now, if everyone's basically providing an advisory services in some way, shape, or form, I'm yet to see a tax pro that doesn't provide any. But each tax pro has their own way of delivering it, to monetizing it. The first bucket, the first group are just doing it complimentary. Actually, I'm working with someone right now in one-on-one coaching, and this person, I really enjoy working with this person, and this person acquired a tax practice, and the previous owner provided advisory services complimentary to everyone. The previous owner would meet with people before and after church and all. I think it was more of a hobby, to be quite frank. So they were providing it complimentary. The second group of tax professionals are doing it on an hourly basis. The third, a la carte value billing, and the fourth, a part of a subscription. So I think that, you know, other than complimentary, I think whatever you're comfortable with, either hourly rate, a la carte value, or subscription, are the best options. The vast majority of what we do in our private CPA practice is the subscription. We are building in a personalized tax plan and the cost of that personalized tax plan into every client's subscription with our firm each year. I do a little bit of project-based, or what I call a la carte, when I collaborate with other tax professionals that really are still in that growing process of doing tax planning and strategy. So let's look at some numbers though. For hourly rates, all right, and this is these are the statistics that we found and have cited. CPAs offering advisory services charge between $150 and $400 per hour, with rates varying based on expertise and service complexity. I would imagine that enrolled agents would be in that same range. They're very talented people, so think about hourly rates are going to be about $150 to $400 per hour. Project-based or a la carte fees, typically things like business valuations or financial analysis. CPAs usually charge a flat rate between $1,000 and $10,000, depending on the scope of the project. For ours are about $2,700. It includes 2 meetings, and when it comes to a personalized tax plan. So there's no wrong or right answer. I personally like the a la carte better than the hourly. But my favorite is the retainer or the subscription. Firms providing ongoing advisory services often charge monthly retainers between $2,000 and $10,000, offering continuous support and strategic planning. Our minimum subscription, which does include the personalized tax planning that I'm talking about and tax preparation, is $5,000 for our private firm. Our average is about $14,000. There's no wrong answer on that. I'm just being transparent about where our firm is at, and we kind of align exactly with what we're seeing out there. So though hourly, a la carte value billing, and subscription are the 3 models you can use as a tax professional to monetize these opportunities. Or you can just give it all away for free. Let me finish with that second bucket, implementation partners. So in our private CPA practice, we have a lot of implementation partners. I'm going to preface this by saying, make sure that you follow the your ethical responsibilities as a tax professional to disclose if you're being compensated by an implementation partner. That being said, there are several revenue implementation partners that our firm works with. One, specialty tax firms. These are firms that do cost segregation studies, research and development credits, 43L, a bunch of other specialty tax work that we don't have the expertise to do, and we just do a revenue share. If you're licensed to do financial advising, or tax advantage investments, that's another potential revenue opportunity. Payroll processing. Many tax professionals process payroll. We don't. So we set up a revenue partnership with a payroll software provider. Tax mitigation firms. A lot of tax professionals do work with mitigation firms that do some advanced implementations. Business transition specialists. So this could be referring people, bringing in people that maybe are doing valuation work or stuff like that. Software providers for specialty tax needs. So like mileage trackers, maybe material participation hour tracking, registered agents, entity formation. We don't do that in-house. We have a referral arrangement in bookkeeping, controllership, CFO services. And hey, you might have a podcast like us, right? So you might do private events where you have event sponsors and advertisers on your podcast. So that's how you can monetize in that second bucket without you actually grinding that work out. We also have a lot of non-revenue implementation partners that are important, like attorneys, bankers, insurance professionals. Then unless you're licensed to as an insurance professional, real estate agents, mortgage brokers, trust administrators. Those are people that you're going to use as an implementation partner when you recommend things that you're seeing within their client's tax return without necessarily being compensated. But ideas are cheap, implementation is valuable. So if you say, hey, I think you should do an HSA, they say, where do I go with that? Well, go talk to your bank first. There's no revenue from that bank coming back to you, but it doesn't matter. You left your client in a better place than you found them. So those are those two buckets. If you have any questions, again, I would say reach out to us or simply take 2 minutes and go to modernfirm.tax, submit an inquiry, and we will reach out to you.
As always, fantastic topics I think we ran through here. And again, we mentioned various places you can go to for some resources. I think Chrissy did a great job of outlining, a lot of the stuff that you guys have done and have been growing into and expanding within your private practice, which is great. While we were chatting too, I did do, I frankly, transparently and honest, I just got into ChatGPT and put in there, hey, give me 10 credible from credible sources, 10 most common complaints from taxpayers about their tax preparer. And the funny thing, but not funny, is 4 of those of the 10 are directly related to what we were talking about here. So this is in no order. It didn't give me the exact sources from it. Basically just told me as I asked it, industry feedback, or sourcing this from industry feedback, various reviews, IRS reports, and consumer watchdog data. So take it for what it is, grain of salt. We know how it goes. I'll be very quick with these. One of them was limited availability outside of tax season. I think we talked about, advisory is more of a year-round relationship role. Another one was no client education, believe it or not, which again, the advisor role, I think, provides that. You become that source. Poor communication was another one, which, I think any industry might get that. Anybody might say it, unresponsive, slow emails, etc. But the one that stood out, and I'll mention all 3 of the bullets that I put under this, it was lack of tax strategy. Vividly says that exactly. And I'll read you these 3 bullets. It says merely data entry with little to absolutely no tax planning guidance was one of them. And the other, not helping reduce future liabilities by offering optimization, which again, we spoke on. And the other one, no year-round support, just transactional services provided at or before filing time. So I think all those are so directly related to what we talked about here. And I would say, Chris, and this is just one question for you before we close. Do you think when you guys started to move more towards this advisory role in your practice, it took time, right? How much, and just very, very briefly, how much do you think this completely revolutionized the way that you guys actually offer value to your clients? I put you on the spot now.
I mean, it changed everything. Yeah, it's a complete shift, right? I mean, it didn't. Yeah, it's a complete shift to advisory. Leading with advisory and planning, and going to a subscription model, and being proactive with your clients. Because that's sticky. That's how clients. You want that client to feel like, what would I do without you or your firm?
There you go, everybody. You heard it exactly from the guy who's lived it and has been through it. And it didn't happen overnight. I can say that again, kind of being along for the process here. I've seen it go through various stages, but yeah, I'm proud to say that I've seen it happen. And Chris, honestly, I see a lot of the people that you do consulting work with, a lot of one-on-ones, groups in our mastermind, etc. I love seeing other people now jumping in it and kind of taking those changes to the next level. So as we mentioned, there's resources we spoke on in this specific episode. Obviously, kind of an open book. I think everybody here, if it's somebody we can connect you with, please reach out. We are happy to do so, as well as go back and listen to some of these podcasts. And again, a reminder, I would say majority of these podcasts, I think we're at number 24 now, you actually get a CPE for. So if you're about to do a road trip, get on a flight or something, go back. Collect these things like you would, Pogs back in the day, or Beanie Babies. I don't know. There's all kinds of examples. But jump on them, take advantage of it. Again, it's free. It's not cheap in value. It's free to you. Extreme value in every one of these. Check them out. Let us know any topics that we may want to hit on that you got going on in your world. So, again, thank you for everybody joining us here. Thank you for the ideas. And if we don't see you in an event live soon, we'll see everybody back here again next month on the Mr. R Show.
You've been listening to the Mr. R Show, presented by the MRR Institute. For more content like this, be sure to check us out on YouTube for weekly expert tips. And don't forget to subscribe to this podcast to stay updated on the latest strategies for scaling and modernizing your tax practice. Looking for more? Contact us at mrrinstitute.com for practice resources, coaching opportunities, and a peer-to-peer mastermind group. Thanks for joining us, and we'll see you next time.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.